TV18.
Hello and welcome to a fresh new edition of Taking Stock. We look back at the week which has gone by, and an absolutely fantastic week we've had in terms of gains. 8% on the Nifty, much more on other indices. But what do markets do from here? We look ahead and tell you what you need to know, the opinion, and of course the data which will come to matter. I'm Prashant. With me today my colleague Surabhi. Hi Surabhi.
Hi Prashant. Yes, what a week. 4 trading sessions and the mood can be so very different, right? A 7.5, almost 8% rally on the index. Well, we'll be discussing all of that. Today we have with us Ajay Srivastava of Dimensions Corporate Finance. In just a bit, we'll get that conversation going. Also, plenty of opinion coming your way. You will hear from market experts like Manish Sonthalia of Motilal Oswal, Hugh Young of Aberdeen, and also Tahir Badshah of Invesco Mutual Fund. But before we get started with all that opinion, let's just quickly rewind back and take a look at what has really been a breathless week for the bulls. As I said, almost 8% up on the Nifty, 10% on the bank Nifty, and financials, literally stomping back on the street. The huge surge that we've seen in financials, whether it's banks or NBFCs, that's been one key highlight of the week. There was no major earnings disappointment. So what really fueled the rally, if you talk about it? No major earnings disappointment. And most importantly, a huge global risk on as well. Everybody has one word on their mind, and that is remdesivir, this Gilead drug. Towards the end of the week, we got to know that some of the US trials seem to be a little more favorable, and that really got the bulls going. In addition, remember, this was the week of the central banks. The BOJ is printing more. The Fed didn't do anything, but again, it reassured its intent of being there and doing whatever it takes. And of course, ECB in sync with that thought process as well. The other good aspect for the bulls was the fact that we had huge rumblings in the debt market, in the debt mutual fund space with the fold-up of Franklin schemes. But thankfully, none of that spilled over to equities. So there was no worry from that front, at least as far as the equity market is concerned. However, we are coming to some very, very critical levels now. The index has simply crushed past the level of 9350, didn't even stop for a pause. And now we have been knocking at the doorsteps of 9,900. So the key question, is this simply going to continue? Is 10,000 just sort of another number now? But also whether there is a bit of a hint of over-exuberance coming in the market. That's something that perhaps one will have to look and ask. The other thing is, how will the reopening play out? As Prashant mentioned, when we come back on Monday, we will have more evidence in terms of which state is doing what. So these are some things that we'll keep in mind. More conversation on this with Prashant in just a moment. But first, let's go across to Sonal to get a wrap-up of all the stock action of the week. Sonal.
Thanks a lot for that, Surabhi. Well, this sectoral indices too did really well. Metal index being the top gainer, up around 13%. Nifty IT was also up around 10-odd%. The only fly in the ointment, that was pharma index, down around 2-odd%, because remember, the pharma index had done really well this month. Let's get to individual stocks then. Of course, the biggest gainer this time around was Tata Motors. Maximum rally came in today itself, up around 26% this week. Metal names like Hindalco, JSW Steel were also one of the top gainers. UPL did well, up around 25-odd%. The others were the financials, the likes of IndusInd Bank, HDFC, up around 21 to 22%. ONGC also did really well, up around 18% in trade this week. On the flip side, we had the losers coming in basically from the pharma space. Sun Pharma being the biggest loser this time around, down 4%. We had Cipla, and the other segment that didn't do so well was the FMCG space. So HUL and Asian Paints, those were the biggest losers as far as the FMCG space is concerned. In the broader markets, we had the financials again doing well. Bandhan Bank, Manappuram Finance, RBL Bank, all up around 20 to 32%. Just Dial, on the back of that buyback news, did really well. ICICI Pru, after good set of numbers, and Motherson Sumi, because they have opened some of their capacities globally, that did really well for the stock this time around. And the list of losers also has names coming in from the pharma names. Marico, Lupin, Kadala being the biggest losers this time around from the F&O space. Granules also was down around 3-odd%, and some others FMCG names also didn't do so well. So it was quite divided as far as the movement in markets are concerned this week. Back to you.
Sonal, thanks very much for that. So that's basically a comprehensive wrap out of what happened in the week. Now let's just look ahead. The Nifty, as of Friday's close, has completed the 50% retracement of the entire fall. That number was basically at 9,879. Friday's high was about 10 points above that. That was 9,889. And then, of course, there was a pullback as well. I mean, there was a pullback and then there was a pullback higher. So it was a volatile kind of day. But the fact is that the 50% retracement has been taken out. The next stop in the sense of looking at big important upside kind of levels is the 61.8% retracement. Actually, that's a very big one. That stands at 10,438. So that's still some distance from where we are right now. What will determine whether the market actually does a 61.8% retracement or it stops here are probably going to be the following. The Prime Minister's address over the next 3 days, we don't know, we don't have a time yet, is going to be important in laying out a plan for reopening the economy. People that I've spoken to are expecting not a complete reopen, but basically reopening. I mean, some sort of relaxations in areas which are deemed to be safer, green zones, for example. And then the market will go to work trying to figure out which are the industries based out of there, which are the companies which are still in red zones, which are completely locked down and unable to restart, and that kind of thing. Some of it, by the way, has already been happening if you see the price action over the week gone by. But I think, the May 3rd and what happens post the 3rd of May, I think was going to be extremely important. By the way, the rally may seem excessive, but just go back into history and remember one thing, that in many times after serious falls, the Nifty has actually come back to 61.8% retracement before the next sell-off happens. I mean, after a collapse, it straight away bounces to 61.8. In some cases, even to the 78% retracement, which would be even higher before the next wave sets in. The US market is already very, very close to a previous high. I'm talking about the Nasdaq specifically. The S&P still has got some distance to cover, some 500 points or so. So the fact is, the rally may seem excessive, may seem too stretched, but if you look at history, these sort of bounce backs tend to be extremely severe, extremely sharp. So don't lose sight of that and say, well, this is it, and the market now starts to turn around already. So I think a couple of points there to watch out for. Let's put some of these questions to Ajay Srivastava of Dimensions Consulting, who's joining us right now to tell us what he makes of things. Ajay, thanks very much. Good to have you here. A lot of people were saying that, well, you should buy stocks during the lockdown and then maybe pare down positions once the reopen happens. Do you think it'll pan out that way? I mean, I know it's a simplistic sort of a line that I'm using, but does it sort of tell us that the trajectory may be similar? We've seen this big bounce, and what happens now as we are standing right at the edge of a reopen?
It is not simplistic, Prashant, it's profound. And the reason I say so is that, you mentioned the US market, the Indian market, and I call the Indian market the great Indian rope break, because US had to give $2 to $3 billion of stimulus package, plus Fed had to come in with $4 billion for the market to recover. Indian markets have recovered with no stimulus at all, which is a great Indian rope break because we don't really need anything. We'll recover on our own with no stimulus at all. Now, when you look at these kind of rallies, the only thing which comes to your mind is only one. That one, you sell out, as you rightly said, as the lockdown opens, you sell out what you have in making profits. Now you recovered quite a bit and so on and so forth. And more importantly, remember the Indian rope break is because SEBI put a great amount of weight on the shorts to say that your margin has to be 100% of the position. I wish now we can at least let that thing reverse and market come to equilibrium with shorts and longs, bulls being at equal par level in terms of margin. Then we shall see what happens. Artificially, you can cut the shorts out and take the market up, which I think, in my view, this is what has happened. Fear is lost in the market. There is no COVID. We'll open up. We'll start afresh. And when things like Tata Motors start to go up by 20%, I call it a Braveheart stock. And if people who have seen Braveheart know how the end of Braveheart happened, right? So to me, it's very simple. What you said is profound, not simplistic. Ride it through. Do not take up too much of exposures. Enjoy what's happening. And when the lockdown opens up, start selling out your positions, because this is not tenable. And with no stimulus package, we are the only country which has recovered such kind of stock market indices, because shorts were put into a cage, because with no stimulus compared to the rest of the world. And this will not last long. So enjoy today, enjoy the lovely weekend, but be careful, lockdown opening and your exiting should be coterminous.
Yeah, I mean, it would seem very counterintuitive, right? But that is always markets for you. I mean, what you are saying one should do is, as the economy reopens and things start functioning again, you should be paring down positions, taking profits if you've bought at lower levels. I mean, that is counterintuitive, Ajay.
No, it's not counterintuitive. The fact is that's why I said for comparison that if we're taking sustenance from the fact that global markets have recovered, the background of global markets is whether it is UK, US, the two biggest markets which have recovered, is a huge stimulus package right down to payment of salaries. Now tell me something with the whole recovery. People are not going to pay salaries in April, salaries are not going to be paid in May. The cliff is already here. We are now on a cliff called April end where the salaries will have a problem. You can open up the markets, and if you're not going to open up the bigger markets like Delhi and Punjab and Bombay, etc., that's 60-70% of the consumption of most of these things, whether it's autos or whether it's any other product. So if those remain closed for the next 2 to 3 more weeks, as far as the outlets are concerned, then the biggest 70% of sales is out of the window in any case. So my point is very simple. No stimulus, market uncertainty for the major consumption centers. You want to take the ride up on the thing, be my guest about it, but then that's when the time to come out as well it is. And I think, I was having a conversation with Lata some time back, and she said a very good thing. We were discussing mid-cap and all. She said, yeah, mid-cap fell a lot, but there was a time to get off the mid-cap as well. This is also a market to get off because, Prashant, you can see it now that end to end, look at last 5 years, look at last 3 years, end to end, equity returns, whether direct or mutual fund, have been pathetic, have been lower than debt, have been lower than anything else you can come to the mind, which tells you that you need to get in and out of the market, number one. Number two, churn your sectors rapidly. This whole model of buy and hold for 5 years has not worked, is not working today. So I'm not saying you can time the bottom, you can time the top, but you can certainly time the quantity of your exposure to the market given the state of the economy is. And ultimately, fundamentals will come. We may have a short run. We saw last year, why we did not see last year, by January we saw the liquidity rally and you saw the end of it. Events do find a way to come and dictate the fundamental on the table.
Ajay, it's always such a pleasure listening to you, and I think more so when we are taking stock of what's been such an interesting week for the market, the great Indian rope trick. Now, I'm just going to put forward one counter. The only counter that I can think of is that what happens if in the next couple of weeks we get to hear from Gilead or one of these other great companies that indeed there is a definitive vaccine and it's coming in the next, let's say, 3 or 4 months. All I'm trying to ask is that in that case, this market could go up another 10% from here before the sell down really sets in, couldn't it? So how do you play this if global strength continues to be as strong as what we've seen in this week?
See, anything can happen. Good thing can happen, bad thing can happen. You're right. Remdesivir becomes the sole remedy, and at least we find that we can cure ourselves with it, so we're not as fearful as what we need to be today. Sure, it can happen, and market can go up another 10%. Market can go up 10% without Remdesivir as well. So I think, Surabhi, that's the point at the end of the day is, this is a rally which has now lost fear in terms of the disease per se. That we'll open up, we'll start to work, things will start to happen, and if the medicine comes, then everything will be hunky-dory. Now, you can take a call whether that's true. And I, for India's sake, always say that look at where we were pre-COVID. Pre-COVID, our growth rate was lagging, the consumption was lagging dramatically, the industry was asking for a package and so on. So forget COVID for a minute, just go back to the month of February and see where we were, what our GDP growth rates were, and what we were expecting. On top of that, we have COVID, and top of that, we have no stimulus package as of now. So therefore, you can take your call that is it just a COVID problem India is encountering? See, US was coming from the highest growth ever as a bumbling economy in 100%, almost zero unemployment, and stock market at a great level. That's where US came into the COVID. We came into COVID with growth at the lowest in I know how many quarters it was falling continuously, and the demand was really falling apart, and the employment was at its highest or maybe close to thereabouts. So you can look at two economic systems and two perspectives and then come to the conclusion whether our stock market should be at what pricing, and if you are putting your money in, would you allocate, if you can have a means to allocate more to other countries or put all of the money into India, and whether India will be a great consumption story for the next 12 months. Let's remember that infrastructure will struggle. Fiscal deficit is not going anywhere. consumption was struggling, they're going to struggle much more. Are you saying that so many unemployed in this country and they'll consume the same amount of goods and commodities and maybe grow on that basis? The only silver lining is agriculture, perhaps, which is doing well, and they should add up to something. I'm not saying all is negative, but I can't believe the fact that if you look at pre-COVID, put COVID's disruption on it, even post-Remdesivir, for next 12 to 18 months, it's a great uplift story. Stock market, we can do wonders. As I said, don't worry about the market was going higher and higher as the economic story in India was going lower and lower. So that's all right with me. But did that end well for the investors? The investors lost a ton of money believing that story. And all I'm saying to the investors is, we have also lost in our position which were there when the market fell down. So it's not that we have been great and we didn't lose money on that day. But the fact is that you got a lesson, you saw it happening just now. Would you want to do it again or take your money off the table, relax? You will get time to buy. That's our view. You will get these stocks to buy at much lower levels than in this euphoria. Give it time, because the way the economy is progressing, unless a great stimulus package comes, then I'm all for it. But 10% plus minus can happen tomorrow.
Okay, you will get more time to buy. On that note, we're going to take a quick break and we'll ask Ajay then, in that case, what to buy when that time comes in just a moment. Welcome back. You're with us on Taking Stock, and we're continuing our conversation with Ajay Srivastava. Now, Ajay, I want to talk about some of the key themes that stood out this week. This is a week where one of the biggest corporate banks of the country came and told us, look, we're taking a huge amount of provisioning because we're padding up. This is going to get rough. This same week, the bank Nifty pole vaults 10%. What is happening here?
I think you made the two statements, and I'm sure there is a smile, and I can't see you with a smile on your face that what's happening here? What's happening here? Exactly what you said, the great Indian rope trick. In a risk on, the market does not look for anything called negative. We will pick out all positives from the negative, and in a bad market, we'll pick up all negatives from a positive. That's what is happening at the end of the day. But having said that, I think, let me be honest to you. The fact is that post-2008, the lesson we learned was that banks will make the maximum money. It's a beautiful trade. Look at what RBI has done today. You are getting repos at 4%. You are lending to the state governments at 8%. Who's paying the interest? From the taxpayer's pocket. Who's enjoying the 4% arbitrage? Is the banks in the middle. They are arbitrage. Look at all the repos at 4%. And when he doesn't have money to put in, he goes and gives it to RBI overnight at 3.75. What's happening? Corporates, mutual funds are giving money to the bank at as low as interest rate as 0.25, 0.5 for overnight funds. What it does is cuts a check, gives it to RBI, and makes 3.75. Now tell me an industry which is structured so beautifully by the Reserve Bank of India to continuously make money of 3 to 4% NIM with no risk. The fact is that what this whole thing has done for the Indian economy is taken it down absolutely to the ground, because the way we allowed the banks to function is make 4% NIMs without taking risk. So when people say, why they're not lending? Now, if I was used to be ex-banker. If I am a banker and someone tells me I'm making 3.5%, 4% with no risk, and I need to go give it to the bicycle maker or an ancillary or somebody and then recover it and then provide for it and so on and so forth, why would I do it? I would not do it at all. And therefore, I keep saying that banking is the best sector unless something dramatically changes the regulatory scenario. This is a sector you must have buy, because there is nowhere in the world where you get to make 300 basis points of free money, riskless money, day in and day out. Look at what you did to National Bank. Force them to lend, and you see today where they are at the end of the day. The private banks don't want to lend to anybody. They want to lend to state government. They want to lend to repo rate. They want to lend to the AAA, and they make the money. RBI is giving them 4% money free of as much as they want today. So it makes sense to buy banks. It doesn't matter. You may have a few write-offs. I think banks makes enormous sense, but the way the equation is 4% guaranteed money and enjoy life.
Okay, forcefully argued and explained passionately. That is Ajay Srivastava for you. Never disappoints, and he hasn't this time as well. Ajay, thank you very much. It's a pleasure listening to you. Appreciate your time here on Taking Stock. Okay, the big number which came out was Reliance Industries, which reported for the fourth quarter. My colleague Sonia is here with a quick update and a roundup. Sonia.
Well, thanks a lot for that. Reliance Industries reported their Q4 numbers, and the refining and the Rel Geo business was very strong this quarter around. So just to tell you, the net profits that Reliance Industries reported, the adjusted net profits before exceptional items came in at 10,813 crores. This was slightly above the street estimates of 10,700 crores. Now, there was a big exceptional loss of 4,267 crores due to a non-cash inventory loss that the company posted due to a drop in oil prices and demand destruction because of COVID. Now, the refining sector EBIT was much better than expected. The EBIT was down about 3.8% quarter on quarter, but the gross refining margins at $8.9 a barrel were better than the street estimates of $7.8 a barrel. Apart from that, the big positive really was Reliance Jio. The operational performance was very strong. The EBITDA was up 15% quarter on quarter, and the profits were up over 70% for Reliance Jio.
Well, right now, let's get you some more market opinion. We caught up with a whole host of experts throughout the week, and here is what they made of this big rally on the Lal Street, despite all the disruption posed by COVID-19.
We believe that 10,000 on the Nifty and sustainable levels beyond 10,000 is only possible post-December. So between now and December, I think the markets are going to hover between 9,000 and 10,000 broadly. We broadly feel that BFSI as a space is likely to be an underperformer, and so the allocations that we have had in the BFSI space is being reduced, and basically the allocation moves to consumer staples, IT and pharma. I mean, I think that these would be the stocks that would actually do much better than the financials.
With markets doing what they're doing, up 5% one day, down 5% the next, opportunities will present themselves. I think in a broader context, I mean, India's, well, up until recently, relative underperformance has certainly made it more attractive in a relative sense. And typically in an emerging markets fund, what is your biggest relative comparison? It's of course China, where the market has held up remarkably well through this.
We have passed that point of real max fear, and I think now market is willing to evaluate things on a more rational basis based on incoming data, whether it is with respect to the virus, whether it's with respect to policy actions, or probably now as we get into the results season, even with respect to individual results of companies, although they might not necessarily matter as much. We'll have to probably see the crucial June quarter result to understand the extent of the damage. But I think we've made a fair climb from that perspective, and well, we are somewhere in the middle now. I mean, I can't really argue for a very significant increase in the markets immediately from here on. We should likely consolidate here for a while, maybe a 5 to 10% upside at best, if I were to probably zoom it on to the shorter end.
Okay, so that's important opinion that you need to take note of. It's been a tremendous week, and the next one promises to be equally, if not more interesting, probably not in terms of price action, but in terms of news flow and that much awaited restart of the economy. Surabhi.
Absolutely, and we are going to be here to take you through all the action. Have a great weekend, and we're going to see you with the markets bright and early Monday morning.